What are the best stocks that you should be buying in July of 2020? In this video, I'm going over my 7 top stock picks for the month. I've done tons and tons of research, and these are the stocks that I think you guys should be looking at if you want to make some money. We recently saw the fastest decline in stock prices ever when the pandemic hit, followed by a huge rally almost back to pre-pandemic levels. And recently, the S&P 500 has been down only about 15% from its all-time highs. Right now, the stock market is crazy volatile, and it's possible that we see this continue for at least a few more months. However, even with all this chaos, I think these 7 stocks will continue to do extremely well. My first stock pick is Upwork, stock ticker UPWK. This is a platform that lets you hire virtual freelancers or work as a freelancer. As the gig economy grows and demand for remote jobs goes up, I think that Upwork is going to do extremely well. So right now, Upwork is trading for $14.11 with a 52-week low of $5.14 and a 52-week high of $17.75. Obviously a huge range for the stock price, but if we take a look at the stock price for the last year, we can see that it's been going down for quite a while now. And back in April, that's when it really started jumping back up. And now it's around 20% off its all-time high. Due to negative earnings, they currently do not have a PE ratio, and they also don't have any dividend. Its current price to book ratio is 6.32. And of course, since they're not profitable yet, their profit margin is negative 6.83% with a return on equity of negative 8.56%. However, they have a pretty solid current ratio at 1.68, which means that they have 1.68 times the current assets as current liabilities. I always like to see how analysts rate these companies. So on a scale from 1 to 5, 1 being a strong buy and 5 being a sell, analysts currently rate Upwork as a 2, meaning that it is a buy. The current average price target, however, is $12.71, which is lower than the current price of $14.11. Although unemployment is going down, over 1 million people are applying for unemployment every single week. And with growing virus cases, investors are looking at companies specifically like Upwork who are perfectly positioned for this new type of economy. Business owners will also be increasingly looking on this platform to hire outside work. Now, I will say that one big challenge that Upwork faces is extreme competition. There are many other sites like Upwork, for example, Fiverr, plus the fact that Upwork has thin margins and the fact that it hasn't made any profit yet makes some investors quite wary. We've seen its stock price trending downward ever since its IPO, but I do think that the numbers are looking much better now. In the first quarter, revenue grew by 21%, from $68.5 million to $83.2 million. The company also increased the number of high-paying client accounts who spend over $1 million per month. The CEO also has high hopes for Upwork and thinks that this company will have over 20% growth year on year. So guys, this is a company that I really believe in and I think fits the bill for the growing trend towards virtual jobs. I envision a world where people from one state are able to work for a company located in another state or even different countries. This is definitely a growing industry, and that's why I think it has a lot of potential and growth for the long term, making it a strong stock to consider for July of 2020. All right, next up on my list is CIT Group, stock ticker CIT. This is a financial holding company and bank company that owns CIT Bank, which you may have heard of. CIT is currently trading for $19.20 with a 52-week low of $12.02 and a 52-week high of $53.40. Taking a look at the price chart for the last year, we can see that it remained pretty constant all the way until March when we saw a huge drop through April. And since, it's just been quite low, it's recovered a little bit, but not too much. Due to negative earnings right now, they currently do not have a PE ratio, but they do have a very strong dividend yield of 6.64%. Their current price to book ratio is an extremely low 0.4, meaning that they are only trading for 40% of their book value. They have a profit margin of negative 11.98% and a negative return on equity of negative 3.64%. Analysts rate Upwork as a 2.2, meaning it is a buy. And they have an average price target of $29.60, which is much higher than the current price of $19.20. So I wanted to include a rather risky bank stock on this list because I do see a ton of upside in this company. It also currently pays a huge dividend of 6.64% based on its current valuation. The last payout occurred in May, and the dividend paid per share was 35 cents. CIT Bank is known for its high interest rate savings accounts. And if you watch or read any of the top online savings accounts, videos or blog posts or articles, you'll see that CIT comes up frequently. With the growing popularity of online savings accounts, and since literally everyone's talking about them, including yours truly, I think this is a great opportunity for CIT Bank to stand out. It's also doing a ton of lending, which of course puts it at risk in this current climate. For example, they just arranged $80 million of financing for an 80 megawatt Pioneer solar project in Colorado. CIT is down a ton due to the pandemic, and that's for a good reason. But I do think that it is too drastic, and I think that it will return to pre-pandemic levels, at least at some point. That plus the sky-high dividend makes this a rewarding but risky stock to invest in. Third up on my list is Shopify, stock ticker SHOP. Shopify is an e-commerce platform that hosts e-commerce websites for all types of businesses. It's the platform that almost everyone uses to host their own online shops. So even though I've been mentioning Shopify for a while now, and I started mentioning it when its stock price was much lower, I'm still a big believer of this company, and while I think the valuation is quite high right now, I think that in the long term it still has a lot of upside potential. So currently Shopify is trading at $910 per share with a 52-week low of $282.08 and a 52-week high of $928. Taking a look at the price chart, we can see that it's been growing massively with a slight drop in February all the way to April, and then since then it's just been shooting up like crazy. Due to negative earnings, this company also does not currently have a PE ratio, and they don't have a dividend as well. Their price to book ratio is 35.98. They have a profit margin of negative 7.65% and a return on equity of negative 5.11%. So yes, value investors will look at the stock and think that it is crazy to invest in. Now they do have a very strong current ratio of 9.45. Analysts are a little bit more iffy on the stock, and they currently rate it as a 2.6, meaning it's between a buy and a hold. And one thing that is a little bit concerning is that the average price target is $743.86, which is much lower than the current price of $910. Obviously, the pandemic was a huge boost for Shopify. Lots of stores realized that they needed some type of online presence, and as a result, they turned to the king of e-commerce platforms, which is Shopify. However, even in 2019, Shopify was performing amazingly, with total revenue up 47% for the year. Now that we were in the second half of 2020, they have actually maintained that growth. The reason why I like Shopify, even with its current extremely high valuation that, of course, value investors will not touch, is because of the untapped market. There are about 30 million small businesses in the United States, and of course, even more across the world. Shopify has only signed up a very, very small percentage of these business owners, and I know that they can easily 5x the number of stores on their platform in not too long. They also make money from processing fees, loans, and apps. Yes, they are losing money now, and that's because they spend a lot of money on marketing as well as acquiring businesses. For example, they recently acquired 6 River Systems, and a lot of their cash flow is currently used for marketing purposes. These costs will go down over time, and as their subscription and other income sources go up, profit is guaranteed in the near future. They also have a new partnership with Walmart, and this deal will let 1,200 of Shopify's highest performing merchants start selling their products on Walmart.com. I won't deny that Shopify is extremely overvalued right now based on the numbers. But from the looks of it, buying this overvalued stock right now is okay. You will still turn a healthy profit in the long term. And I'll always keep saying this, but Shopify is the next big Amazon. Okay, next up on my list is Electronic Arts, stock ticker EA. This is a huge American video game company, and they have put out games such as Apex Legends, Madden, Battlefield, FIFA, and much more. Currently, Electronic Arts is trading for $130.93 with a 52-week low of $85.69 and a 52-week high of $133.60. Looking at the price chart, we can see that they've been steadily increasing for the last year, but in March they hit a little dip, but since then it's been going back up quite fast. EA has a market cap of $37.8 billion with a PE ratio of 12.71. They have a 5-year expected PEG ratio of 4.22 and a price to book ratio of 5.06. Looking at the profitability, EA does pretty well, and their current profit margin is 54.88%. Their return on equity is also extremely strong at 47.51%. And looking at their balance sheet, their current ratio is 2.45. Analysts currently rate EA as a 2.1, meaning that it is a buy. And the current average price target is $127.45, which is a little bit lower than its current price of $130.93. EA stock has been rising due to the pandemic, where people are staying home more and just spending more time and more money on video games. It's been the same with other companies such as Activision Blizzard, Nintendo, and Take-Two. According to analysts, EA's growing franchise base and strong pipeline of new games means that EA should see continued growth of about 5 to 10% per year. The release announcements of consoles such as the PlayStation 5, Xbox Series X, and also upcoming games like FIFA are also contributing to the rise of the stock price for EA. There's a lot of pent-up demand for sports, with sports currently being on hold. And I do think that fans and gamers want to see more sports action. This will lead to big sales for the rest of 2020, and if we do see another wave of this pandemic, then of course that's going to create even more demand for video games. One thing I do think EA lacks is strength in mobile gaming. And this is an industry which I see having huge gains in the next decade. But overall, I think EA is really well positioned, and I think it's going to be a very strong stock to hold on for the next few years. Next up on my list is Cisco, stock ticker CSCO. This is a company that develops, manufactures, and sells networking hardware, software, and more. So I wanted to include at least one reliable and safe stock on this list. I like Cisco because of its relatively low PE ratio and because it has performed really well even with stiffening competition for this networking giant. If you aren't familiar with Cisco, their value exploded during the dot-com bubble, fell spectacularly, and still has not fully recovered since then. Currently, Cisco is trading at $46.31 with a 52-week low of $32.40 and a 52-week high of $58.26. In the last year, we've seen their stock hold between around $45 and $50, but in February, we saw a big drop through March, and since then it's been recovering. Their current PE ratio is 18.36, and they have a dividend of 3.18%. Their 5-year PEG ratio is 2.84, and their price to book ratio is 5.35. They currently have a profit margin of 21.32%, and they have a very good return on equity of 29.74%. They also have a pretty decent current ratio of 1.59. Now, analysts currently say that Cisco is a 2.3, meaning that it is a mild buy. And the average price target is $48.81, which is about 5% higher than its current price of $46.31. Cisco's only up about 2 times over the last decade, but it does have a decent dividend yield of 3.18%, and this dividend has been on the uptrend for the last 9 years. It's retained its spot as the world's biggest supplier of network switches and routers. Yes, there are lots of competitors such as Huawei, but Cisco remains strong with its moat and other advantages. Cisco is always buying quality companies that add to its value and strength. They still have a lot of cash on their hands, so they could definitely keep acquiring more companies if they see something pop up. And they also do a lot of share buybacks, which is good for investors. Buying Cisco stock will not give you huge returns, but it will give you stable returns and a good return on your investment. Number 6 on my list is Netflix, stock ticker NFLX. This is the world's leading entertainment streaming and production company. Yes, Netflix has grown a lot recently, but I do think that this is just the beginning. Currently, Netflix is trading at $443.40 with a 52-week low of $252.28 and a 52-week high of $474.01. We actually saw a small price drop in the middle of last year, but since then it's been going up quite significantly. Netflix has a market cap of $195 billion with a PE ratio of 89.74. Looking at their PEG ratio though, we can see that it's 3.09, and they have a price to book ratio of 24.37. Netflix has a profit margin of 10.43% with a return on equity of 31.63%. One thing they are lacking in is their current ratio, and they have a current ratio of 0.82. Analysts currently rate Netflix as a 2.3, meaning that it is a mild buy. The current average price target is $455.46, which is just a smidge over its current price of $443.40. 2019 was a huge year for Netflix, with a 20% increase of subscribers all the way to 167 million. Its revenue in 2019 also jumped 31%, which is phenomenal. 2020 is also a big year for Netflix, with Q1 seeing growth to 182 million subscribers and even bigger revenue gains. Netflix also thinks that Q2 is going to be big, forecasting an increase of 7.5 million subscribers. Netflix profit margins are still quite low, at least compared to other streaming providers. And I think that they can definitely increase these margins over the next decade. They have an extremely low customer acquisition cost, but yes, right now they are spending a lot of money creating new content, but this is going to pay off with all these new subscribers coming in. Netflix has also successfully expanded into many overseas markets, and they'll continue to grow rapidly in those markets just like it did in the United States. Yes, its PE ratio right now is very high, but with revenues expected to go up a lot and also profit margins expected to go up a lot, such a high PE ratio doesn't sound quite as bad. Netflix is the king of streaming and content, and it will continue to grow within the next decade. Though we may see some drops in the short term, I think that Netflix is a very strong buy for the long term. All right, next up on my list is Microsoft, stock ticker MSFT. Microsoft is currently trading at $196.33 with a 52-week low of $130.78 and a 52-week high of $203.95. Microsoft's stock price has been doing extremely well, and you can see that they've been going up with a big drop in February and March, but since then it's been rebounding quite fast. They have a market cap of $1.489 trillion and a PE ratio of 32.71. They also have a small dividend of 1.02%. Microsoft's PEG ratio is 2.44 and they have a price to book ratio of 13.27. They do have a very good profit margin of 33.36% and they have a return on equity of 44.2%, which is extremely high. They also have a very good current ratio of 2.9. Analysts currently rate Microsoft as a 1.7, meaning that it is a pretty strong buy. And the average price target is $201.11, which is a little bit higher than the current price of $196.33. In the news, Microsoft just announced that they would be closing all their retail stores around the world, leaving just 4 locations that will be turned into experience centers. This pretty much is to focus on their digital storefront. And this makes sense as just 2% of the revenues came from these retail stores, so I do think that they can double down on their e-commerce. Analysts expect Microsoft to post returns of $1.40 per share for the next report. This would mark year-over-year growth of 2.19%. Its major revenues over the last months have been through its server and cloud services. Specifically, the Microsoft Azure cloud platform has tons and tons of potential. Analysts are saying that its market cap could hit $2 trillion just based on the strength of the Azure cloud computing business. In terms of cloud providers, Amazon is still currently the biggest, but Microsoft is pulling in close. In fact, it's growing so fast that analysts do say Microsoft's cloud position will drive double-digit growth for the next few years. Right now, Microsoft is a bit overvalued, just like a lot of other companies. So whether you buy now or you wait for another dip to buy, it's really up to you. In the long term though, I think any time is going to be a good time to buy for Microsoft. It's a company that you can't go wrong with for consistent and long-term growth. If you guys haven't signed up for WeBull yet, make sure to do so. Deposit $100 into your account and you'll get 2 free stocks worth up to $1,650. I personally use this platform, and since they're giving out 2 free stocks right now, it's the perfect time to sign up. It's an easy to use platform, it's free to use, and it's way more powerful than Robinhood. So yeah, you guys, those are my top 7 stock picks for July of 2020. I still believe in many of the other stocks I talk about in my other top stock videos. So if you want to check those out, I'll leave a link to them in the description below. As always, you guys will want to do your own due diligence before investing in any stocks. Use this video more as entertainment purposes and as a guide to get you started. But yeah, the stock market is very volatile right now and we don't know what's going to happen with this virus, so make sure to trade cautiously. If you guys found this video useful, make sure to share it with a friend and also hit that like button and subscribe if you want to see more videos just like this. I make a ton of content about investing, personal finance, and entrepreneurship. So yeah, that's it for today. Thank you so much and I'll see you guys in the next video. Peace.